Hi, I'm Fred Stewart. I'm an agricultural lender and your host for this video presentation. As I work with farm families who borrow money, I'm interested in the financial position of their farm or ranch business. The financial statement I see most often is the balance sheet. I use the information reported on a balance sheet to measure the risk-bearing ability or financial solvency of the business. I'm impressed by farm families who can provide and understand this financial statement because it is one indication that they are good financial managers. If a person is a good financial manager, then that person will probably be a good credit risk. So that's why it's important to acquaint you with the balance sheet and how to prepare and use it successfully. We won't have time to discuss all the specific aspects of the balance sheet today, but maybe we can make you aware of areas where you may need to seek additional advice. Today we're going to focus on the definition, uses, structure, asset liability valuation techniques, and preparation of a balance sheet. We're also going to look at the recommendations of the Farm Financial Standards Task Force. That task force has been charged with establishing financial standards for agriculture. I'm sure their recommendations will have an impact on balance sheets in the future. Joining me today is Dr. Freddie Barnard from Purdue University. Freddie has authored several extension publications on financial statements and management. He also served as the coordinator for the Financial Criteria and Measures Subcommittee of the National Farm Financial Standards Task Force. Freddie, too, likes to work with farm families, and we find him in the home of one of those families. Welcome, Freddie.
Thanks, Fred. It's a pleasure to be here.
Freddie, what is the Farm Financial Standards Task Force?
It's a group of about 45 individuals from across the nation who have worked to establish financial guidelines for agriculture. It includes representatives from agricultural lending, the academic community, accounting, farm groups, farm software firms, USDA, and other industry specialists.
How will the recommendations of this task force affect how we prepare balance sheets?
The goals of the task force are to standardize the formats for financial statements used in agriculture, to identify financial measures common to all areas of the country, and to recommend standard methods for calculating those measures. The balance sheet we'll discuss today is designed to satisfy the recommendations of that task force.
I'm sure I represent the audience today when I say I'm looking forward to hearing those recommendations. But let's start with a basic definition, shall we? What is a balance sheet?
A balance sheet is a summary of the assets and liabilities of a business and the owner's equity as of a specific date. It's not a report for a period of time. It's a financial snapshot of the business at just one moment in time.
For purposes of credit analysis, Freddie, we lenders like to see some standardization in terms of dates balance sheets are prepared.
I agree. Although it may be desirable to prepare a balance sheet at various times during the year, a balance sheet should always be prepared for the farm business on the last day of the accounting period. Preparation of a balance sheet on the same date each year makes it easier to compare the financial position over several years. Don't you find that to be the case, Fred?
It's very true. You mentioned the terms assets and liabilities. How about some definitions, Freddie?
Assets are all the things of value that are owned by or owed to the farmer on the balance sheet date. Liabilities are any financial commitments owed as of the balance sheet date, including accrued expenses, debts, leases, contract payments, deferred taxes, and other financial obligations.
How about owner equity?
Owner equity is the difference between the total value of the assets and the total value of the liabilities. It's the amount that would be left if all assets were sold and all liabilities were paid on the balance sheet date.
I mentioned earlier that one of the uses of a balance sheet is to measure the risk-bearing ability or financial solvency of a business.
Yes, that's a very important use. It shows the margin by which debts would be covered if the business was ended and the assets sold.
What other uses are made of a balance sheet?
A balance sheet also indicates the amount and type of debt and equity capital used to finance existing assets. This is sometimes called the financial structure of the business. It provides some insight into the liquidity of the business. In other words, can the business meet its financial obligations in a timely manner? Of course, it's usually part of a loan application for securing debt. And finally, it can be used to document the financial position of the business to outside parties, lessor, lessee, potential investor, and family members.
We've defined a balance sheet and discussed some of its uses. I'm reminded of a basic accounting equation. Assets equal liabilities plus owner equity.
It's interesting that you should bring that up. It's that very equation around which a balance sheet is organized.
Please elaborate.
This relationship dictates that the value of all the assets must equal the value of the claims on those assets by outside parties and by the owners. Just as the name implies, a balance sheet must balance. It balances because assets can only be funded by liabilities and/or equity capital.